Hello and welcome to this edition of Market Unwrapped with me, Craig Melling, Director of Investment, and Olivia Reid, one of the investment managers here at Broadening Asset Management. In this edition, we're going to be talking around 2026, what lies beyond, and some of the key themes that are going to impact portfolios throughout the year. Our key themes for this year, Olivia, are broadening, weakening, and steepening. And in this edition, we're going to kind of demystify some of those phrases that some of the viewers will have been hearing about and seeing in the press. But let's just take a look at what's happened in 2026 thus far. It's been an eventful month. We're here the 2nd of February, and it feels like an awful lot has happened already. We've seen Donald Trump trying to take over Greenland. We've seen conflicts with Venezuela. We've seen potentially overthrowing federal Powell chair. How have markets reacted thus far this year?
Yeah, I think you've hit the nail on the head there, Craig. It's already been a busy year, and that sets the tone for the year ahead. Like last year, we expect to see a lot of volatility. Looking more broadly, similar themes to last year. So, broadening of returns beyond the US. So, rather than one part of a portfolio driving the majority of returns, we've seen good returns come from other regions, whether it be emerging markets, Europe, or even here in the UK.
I think that's really interesting because we've seen a few headlines saying the end of US exceptionalism is here. And that's something we're not saying here at Broadening Asset Management. One of our longer term themes and one of the themes we do believe which will continue throughout the next decade or so is the emergence of artificial intelligence. But what we're thinking about this year is actually just that repatriation of monies like we saw in 2025, but for a number of different reasons, whether it be valuations, company fundamentals, or just diversifying portfolios even more because of the uncertain times ahead.
Absolutely. And I think that's driven some of the flows to Europe, the UK, and emerging markets is that investors are starting to become a little bit worried about concentration risk in the US as the world's largest economy, and also those high valuations. So while the hyperscalers, the Magnificent Seven, have impressive innovation and growth, they are very highly valued. So it can be safer sometimes to put money elsewhere where valuations are lower and there's more of a margin of safety.
Yeah. Absolutely. And I think if we start, just take a step back and look at that macroeconomic backdrop, some of the key things for us this year and some of the things we've been talking around in our asset allocation meetings and our investment committee meetings have been global growth, inflation, and interest rates. And I think even this early part of the year, those things are back in focus. Growth looks to be moderate. We've seen positive signs in the global economy, which is supportive of equities. Interest rates are expected to fall, and that leads into the steepening of the yield curve, which we'll come on to in a second. But I suppose the real question mark, and the one we discuss the most, is probably inflation, and that potentially has the biggest impact and causes the biggest risk to our base case throughout 2026.
So this year, we're expecting to see further cuts from the Federal Reserve in the US and also the Bank of England here in the UK. In Europe, it looks like European Central Bank is on hold for now with inflation close to their target of 2%. But this really highlights the reason that we have diversified portfolios with alternatives, because those help provide that protection to inflation should it rear its head again.
Absolutely. And I mean, let's take a look at steepening. What does steepening of the yield curve mean?
So let's start by thinking about what the yield curve is. So this describes the relationship between the length of time to maturity for a bond compared to the return or the yield that it gives investors.
Steepening refers to the yield curve where falling short-term interest rates will incentivize investors to move out of cash or cash equivalents into risk assets. This should be a benefit to equities and potentially some areas of fixed interest, especially those longer duration assets. But I think for us right now, because of the such uncertainty in global markets, such uncertainty with geopolitics, it makes us almost worry about the potential add-on risk of taking that extra bit of duration and actually diversifying diversifiers. And what do I mean by that? We look at holistically how we manage risk. And this is a big theme for us in 2026 across Broadening Asset Management. So we do think fixed interest has a part to play in portfolios, but as we see this cash rollover and investors have a need to look for a home for it. We think equities will benefit. We think fixed interest will benefit, but we actually think diversifying, the diversifiers, i.e. looking at alternative assets, will help manage risk in portfolios and dampen potentially the volatility we'll see in 2026. So far, Olivia, we've talked about broadening. So we think there's going to be a broadening of equity markets outside of the US. We think there's going to be a steepening of the yield curve, which will lead to investors looking for new homes for short-term money. That could potentially be in alternatives, some areas of fixed interest, but in particular, again, another benefit of equity risk assets. And our final topic of today is weakening. And the biggest thing we've been thinking about here is the weakening of the dollar. We've seen over a 10% fall in the value of the dollar over the end of 2025 moving into 2026. Do you want to just explain a little bit about the geopolitics and I suppose the Trump effect initially on why it's been falling?
Absolutely. So if we start with Trump, what we've seen is that over recent years, 5, 10, 20 years, the dollar has been a safe haven asset. So this means that investors all around the world will hold a lot of their cash in dollars because they perceive it as safe. What's happened with Trump is investors have been turning away from the dollar and actually starting to hold cash in other currencies, other assets, whether it be gilts, so government bonds here in the UK, government bonds in Japan and other regions. And as a result, the demand for the dollar has fallen, which means the currency has weakened.
It's really interesting. And there's a number of knock-on effects of a weakening dollar. And it's not necessarily just Trump. We've seen, as we've talked about, there's potential interest rate cuts in the US, which, again, reduces the appeal of the dollar. But actually, when we put that into context and what does it mean for an investor, well, it actually means that assets outside the US look more attractive, in particular emerging markets. When we translate money back from dollars to sterling, there's a big impact there. And we talked about in the last Market Unwrapped that actually last year, not only did the US market deliver 19% in dollar terms, but actually in sterling terms, it was only circa 10%. So it has a wide impact, a weakening dollar, on what actual returns look like in portfolios. And I think investors are going to be really cognizant of that this year. So it kind of plays into that broadening out of assets and broadening out of returns theme we're talking about. But I think investors will really focus on currency this year. And I think Donald Trump's antics or movements or some of the policies we're seeing, again, will really focus investors' attention.
So with all of this macro uncertainty, geopolitics, we think that this year the market will continue to focus on fundamentals. We will try to look through the noise as much as we can and focus on what really matters. And we know that in the long term, the most significant driver of stocks is companies' earnings, and that's the biggest driver of returns.
So the key question is, what does this mean for portfolios? And I mean, a key thing for us is looking at resilience. You know, we've talked about a lot of uncertainties and we've seen a lot of uncertainties already in 2026. But there's also a lot of positives, and we've talked a lot today about how the biggest beneficiary of some of the things and some of the topics is equity markets. So we have to be cautious, but we have to be looking at that long-term market returns, a focus on equities, but looking at fundamentals in terms of valuations and earnings. And in the risk diversifiers and the defensive elements of the portfolio, it's about having a portfolio which is stable, resilient, and that can weather the storm of whatever is thrown at it. So there'll be a blend of fixed interest and different types of alternatives to give us almost an insurance policy with portfolios.
And it goes without saying that we will be focused on growth, inflation, and interest rates and make those adjustments to the portfolios as and when we see necessary.
In the next edition of Markets Unwrapped, we'll be focused on Progeny Asset Management's asset allocation, how we are positioned across asset classes, regions, and what lies ahead for 2026. So thank you for watching, and we'll see you in the next episode.